record. Okay, so that is basic with regards to the modeling. Maybe I'll just share a few terms that you need to pay attention to. And this is basically, I'm still recapping last week for purposes of being with all of us. Okay, so we know that when we're looking at having a good business, we need to grow very fast. And in our case, I mentioned we already did our business modeling. We have already done much of our business plans. My assumption is they are all moving in steadfast order. And now there's the aspect of financial planning, where you need to plan appropriately. The thing is, with business, you may have the money, but you use it in the wrong activities or don't prioritize right. And as such, it makes still the business stand at a deficit, or it fails to achieve its core goals. So financial modeling and planning allows you to start thinking about what are the key priority areas and how can you align your plans so that you can be able to see if you do it like this or like that, does it attract or does it make the business manage to attract the right financing opportunities? And that is why we went into looking at the financial statements which are common as required by financials. One, you have the income statement, and I said in simple terms, an income statement is simply revenue minus expenses. The balance sheet, we use the accounting equation. It's really the status of the business at any particular time. Okay, a snapshot of the business. So here you look at the assets. What you have is equivalent to what you owe plus what you contributed or generated in the business. That is basically what summarizes a balance sheet. And then a cash flow statement is simply cash in and cash out in the business. I still want to emphasize that with financials, you are able to make appropriate decisions. You are able to know. And I think you were able to see that when we were looking at how to balance production, when we were calculating the break-even point of multiple products. And I shared that example. For example, if you are doing juice and each contributes a different product, contributes a different revenue to your product line, you need to weigh it in such a way that you are able to produce appropriately. So imagine as a businessman, you just assume people will buy 1 kilo, 2 kilo, you don't inform yourself. But if you use the information you have, chances are you are likely to produce optimally. You will use your money optimally. And that is the bottom line of financial planning. Okay, you are able to know your average cost of production, your average price, and in those simple terms, you are even able to compute. You see, as an entrepreneur, yes, we work with accountants, which is very important because it gives you full view, but the basic operations of your business are critical for you to understand because that helps you achieve your business goals. Okay, so understanding that is very important. Okay, and we say in simple terms, a simple income statement will be like sales less variable costs, and that will give you the contribution margin or the gross margin. And then when you add the fixed costs or operational costs, you'll get the operating margin. Okay, then as I went through the financial worksheet, I think I've explained what a balance sheet is. Assets are things that you own and they are likely to generate or help you generate some money. Current assets are anything you expect to convert into cash within a year. So for example, if you have an invoice of the service done, that means you're going to pay. That is an account receivable. If you have stock, or Mr. Moses who has and is going to sell, that is a current asset. It is stock that is going to generate revenue. A fixed asset is like land. His avocado tree is a fixed asset because he's going to generate. If I have a coffee plantation, that is a fixed asset. Okay, liabilities are things that you owe somebody. So for example, if I take a loan yeah, pretty much things to do with the loan, I lease on the long term. Equity, that is the difference between what you have and what you owe. And then receivable is really uncollected revenue, while payables are unpaid expenditure, things you expect to spend. Okay, okay, sorry, William, there was some background noise. Okay, so this is the accounting question which applies so much on the balance sheet. It basically says what you have is equal to what you owe plus what you contributed or what the business generated. It's as simple as that. It will never change. And these are examples, but I'm not going to delve so much. Current assets, because some of these are complicated terms, which, assuming some of you may not have encountered, I wouldn't want to confuse anybody. I want us to look at it in the simplest of terms. So this formed the basis of us looking at our worksheet. Maybe just to emphasize a bit of long-lived assets for you to understand. Land is a fixed asset or a long-term asset or non-current asset. Mineral deposits, some of you have a lot of minerals in your land. If you do, obviously you are likely to also interface with government, because minerals are also considered to be owned by the government. When you own, then the government has to find a way of negotiating with you. Timber, if you plant trees, buildings, equipment, furniture, fixtures. Intangible assets, things we do not see. For example, if you have a trademark, if you have a patent. I understand in Gulu we have Covilis. The proprietors of Covilis can be able to go and make a patent, and they can sell part of that patent and franchise in different countries and become multi-billionaires. Okay, this become assets. Software, for example, in Muka, we have a platform. We should be able to introduce most of you entrepreneurs so that you can be able to connect with other entrepreneurs, collaborate. That becomes an asset. Goodwill. Over years, when you are known to be doing something amazing, or you have good furniture shop or whatever, you generate what we call goodwill, which becomes an asset because people trust what you offer. Okay, and the reason why I'm explaining this is physical assets depreciate. We normally attach a value. I think you saw on the worksheet depreciation. Then you saw something amortization. Amortization is now things that you do not see that are assets, they amortize. Okay, just to simplify. It's the same thing, it's just that different terms. Okay. Yeah, I'm not going to start financial options. Let's go back to the worksheet quickly. Let me open the worksheet again. So it is this that forms the basis of what I was explaining to you, that you have receivables. That is amount of money you expect to receive. And as a business, some of you, it takes 14 days for people to pay you. Some take 1 year. If it is 1 year, you put 365 days. If it is less, you put inventory days. How long does it take for you to move your products from what you have done to now the market? If it takes more days, if it takes less, you put accounts payables. What you expect to pay people, you pay people, but probably you delay with their money. Okay, how long do you delay with their money? Is it a day? Is it 2 days? Is it 30 days? you put, okay, capital expenditure. How much do you expect to spend on capital expenses? I think we've explained what a capital expense is. It's basically buying things that will help you generate. Maybe I buy land or I build. That is not an operational, it's a capital expenditure. Okay, so we don't attach a capital expenditure in an income statement because it will not give you a fair assessment of your performance, because an income statement provides an assessment of the business performance over a period of time. Then if we intend to get or borrow, this one shows debt issue and payment, or if we intend to have a partner who will contribute in the business, we can put the amount of money we expect. Okay, for purposes of explaining debt, I'm going to just go down here. You will see something called, you'll find here I've written supporting schedules. So these are calculations that we do down, and they contribute significantly to what to the numbers or the figures in the cash flow, in the three statements: the income, the balance sheet, and the cash flow. So for example, we have here working capital schedule. This is a schedule that is important, and whatever numbers are put here, they contribute towards your cash flow. Okay, they contribute towards your cash flow statement. So you'll find you are going to feed where it is in blue, as you can see. And once you also put the assumptions, you will find this working schedule will compute automatically for you. Okay, that's the beauty of being part of the Pitch Face program. We are able to guide you, but also try to simplify this. Debt schedule, I mean depreciation. Depreciation is you have assets, you buy things, you buy assets. Okay, you buy property. Okay, so whatever you buy each year, you normally put. So here you are seeing what was previously bought. Okay, but still on property equipment, you noticed up we had put what you are to buy. I hope you can see that here. Okay, capital expenditure. So it picks, if I say I'm planning in 2021 to buy some things worth 30 million, and then I say I'm planning to buy things worth 56 million. Then I say I'm planning to buy things worth 70 million. Sorry, this is 70. And then I say here I'm going to buy things worth 90 million. When I put that as capital expenditure, down here, it is on the schedule. It's going to show me my depreciation. Okay, are you see? It has already, sorry, down here, where's the schedule? Yeah, so as you can see, it has already filled. This, I'm going to buy this property, okay? And with this I'm going to buy this. This is my property I'm going to buy. As you can see, it has already put the numbers, and then it calculates the depreciation based on the assumption we put here. Okay, the assumption of depreciation we had put here. And depreciation is really, if it takes you 10 years to replace, then you put 10%. If to replace any product, maybe a car or machinery, but if it takes you 5 years, then you have to put 20. Okay, if it takes you 3 years to replace, then you put 30. If it takes you 4 years, that means it's 25%. If it is 2 years, then that means your depreciation is 50. Okay, so as long as you put here, these are just assumptions. You just put the assumption based on the things that or how your business operates. And the moment you put those assumptions, you'll find down here that it has calculated for you your depreciation, and automatically this closing property and equipment is what it brings to the balance sheet. So you don't need to bother anything in black. All you need is to fill in the details of blue or written in blue, and then what is in black will be computed automatically. And even the graphs will start showing how your business will perform. Okay, so this is a simplistic model. I must say it is we are trying to experiment and get a simple model that we can use. So this is the first that we have refined for entrepreneurs, because in the previous pitch phase, financials were asking for more. Initially, we were just doing income statement and it was simple, having cost of product, but most were asking a bit, can we see the balance sheet and the other things? So we thought of bringing this as a way for you to be aware, okay? Though naturally, usually most of you businesses work with accountants, so you have some basic this information, and based on the information available, you can project, because the core thing that we are trying to do is to project our numbers. Can we say this can summarize our financials? If somebody has a question on this, I'm happy to receive before we go to what we are going to cover today on understanding financial options. Because once you make this, you should be able to know now which kind of finance is suitable for you as a business. Because once you put the numbers and the assumptions, you will know how much interest the business can accommodate if it is a loan. If it is equity, what kind of relationship, at what point can you buy back if you want to buy back your shares or you want it to be continuous? So we are going to discuss financial options. But at this point, knowing the basic finance, because when you articulate your business and say, you know what, I target schools, and each school buys an average of 50 kilograms a term, okay? And and since there are 3 terms in a year, they buy a total of 150. And for me to get or to secure a school, I spend about 20,000, because I have a team which has to visit and then agree, and it takes a bit of time. And so in 2022, we are targeting 90 schools, and the 90 schools each ordering 150 should be able to generate this amount of revenue, and this will be able to give us this profit. Now, imagine a financial or an investor listening to you. They'll be able to assume that you really understand your business. And that's why we added some assumptions which you will find in other financial models are not there. But it's simply to help you articulate your business in a way that people will appreciate that this person really understands what he's doing, and this business has great potential. So, any questions on the financial modeling and planning? I must say I've really tried to make it simple. I know to some it may not be as simple, but I hope with the sheets or the worksheet, at least you can play around, and yeah, it will. You will certainly improve over time. But here we don't need a lot of your expertise. You just need to know a bit of your numbers, and that's okay. Okay. For the technical definitions, I think I've provided, and where is in blue, you can feed in data. Where it is in black, just leave. Moses, question, ask. Moses, you've raised your arm, but you are not asking, sir. Or you have muted.
Hello.
Moses, I'm waiting for your question.
Yes.
Yes, sir.
Mine is a request.
Yes, sir.
Mine is a request, sir, that can we go ahead and fill the template then forward to you for assessment, and you'll be able to guide and correct.
You better do that faster, simply because you know we have a week. We actually have a week for you guys to be ready for